What is going on, everybody? Crypto Ed here. Welcome to day 2 of CoinFest. Hope everybody's having a fine time. Hope everyone's enjoying CoinFest so far. I've been learning a lot about crypto, blockchain, and picking up some of the fundamentals of crypto. And I hope that everybody's doing fine as well too. I mean, like we had a wild last 24 hours, and surprisingly, during the conference, we start seeing some volatile swings in the crypto space. And I mean, like from a fundamentalist perspective, these wild swings will always be there. As long as you're not like doing anything dangerous, like leverage trading, like you will be fine, right? And today, I'm excited to introduce to you our first speaker of the day, Harold Tan. Harold. I would consider Harold as an OG in the space. He has been working with crypto since for a long time, and in fact, Harold has built and exited 2 internet companies and is a co-founder of Green Solar, a business founded on helping homeowners and home builders install solar panels across the United States. He has a passion for empowerment that disruptive decentralization technology provide, and in 2014. He helped transact the world's first solar installation that was paid entirely with Bitcoin. In his spare time, Harold educates on Bitcoin and disruptive technology and volunteers as an entrepreneur in residence at the University of California, Irvine Applied Innovation Cove. So I'm excited to introduce to you Harold Tan. So Harold, the stage is yours.
All right. Good morning, everybody. Hope everybody is doing well and weathering the volatility. We have a lot to get through today in the 1 hour that Ed has provided. So I'm going to jump right into it. All right. Ed, can you confirm the screen sharing is working okay?
Let's see. Yep, we can see the screen sharing.
Great. All right. So we need to start with standard disclaimers. Let's pull them up. Disclaimer number 1, you understand crypto is volatile and contains financial risk. Portfolio allocation matters. Don't ever invest more than you're willing to lose or money that you need in the short term. Number 2, always think for yourself. Do your own research. I may be a well-spoken idiot. Also, don't believe what other people tell you. Always think critically, and I welcome counter arguments to anything I present. Number 3, I am not a financial advisor, and certainly this is for your education, and certainly not your financial advisor. This presentation is focused on fundamentals of a disruptive technology versus how to trade price action. If you want to trade for quick gains, you don't really need crypto for that. Number 4, you agree not to hold me responsible for any financial loss, but you can thank me with a coffee for any financial gain. Number 5, you agree to be recorded for the benefit of those who can't attend. And if you want to speak more personally, I am happy to connect with you outside of these larger group calls. So onward to my personal journey. In 2012, I bought my first Bitcoin around $20. I saw it 50x to a first cycle peak of around $1,000, then crashed to $200. And I was like, whoa, this volatility is crazy. I sold at around $250 for what I thought was a 12x gain and thought that was good. Made a gain much better than stock markets and exited the crazy volatility. And my lesson learned was I need to understand why I'm buying and buy for the long term. In 2014, as Ed mentioned, I'm in Solar, which shares parallels with Bitcoin for decentralization. So Solar decentralizes energy and Bitcoin decentralizes money. So there were parallels there. And during this cycle peak, a customer purchased a solar system, paid entirely in Bitcoin. We converted most of it to cash to pay for cost of goods and thought the real world usage was pretty interesting. In 2017, I completed a course on Bitcoin an in-depth computer science course and started to understand the fundamentals of blockchain. Went through the ICO hype cycle of 2017, through which I divested from BTC into altcoins, most of which are zero today. So the lesson learned was most alts are highly speculative and prone to failure despite using blockchain technology. In 2021, after holding through the crypto winter, I now feel a moral imperative to share what I've learned from prior cycles over the past 10 or so years to aid friends, family, and other people in their decision-making and perhaps broaden their perspective on crypto. I've developed a very high conviction in Bitcoin and will share my reasons why in today's presentation. And this presentation is coming to you from El Salvador. I flew out here to see at ground level for myself what it's like for the first country to adopt Bitcoin as legal tender. So onward to money, which is the primary question around cryptocurrencies and Bitcoin in particular. So money is a subject that needs to be taught in school, or at least from parents to their children. Money is like the background hum of life, and we simply blindly accept its existence for the most part. Money is the apex form of energy that allows exchange into all other forms of energy, such as property or services. And money is the most globally accepted narrative. Yuval Noah Harari writes on the power of narrative in his book, Sapiens, that led humans to becoming the dominant species on Earth. The Greek polymath Aristotle found that money as a common measure of everything allows us to compare values between goods and services. He offered several characteristics for good money that are the foundation for what economists utilize today. Deeper definitions are at the St. Louis Fed website listed. And over time, humans have always evolved from bad money to good money. For example, cows are bad money because they don't hold these listed characteristics as well as gold or US dollars. And this movement from bad money to good money is known as Thayer's law, which states that good money will drive out bad money. Bitcoin is arguably gooder money because it holds more of the characteristics of good money. The purchasing power of the US dollar has fallen over time as money supply has grown. In fact, a dollar in 1913 had the same purchasing power as $26 in 2020. In 1913, the Federal Reserve Act granted Federal Reserve banks the ability to manage the money supply in order to ensure economic stability. So back then, $1 US could buy 30 Hershey's chocolate bars. By the late 1960s, the number of dollars in circulation was too high to be backed by US gold reserves. And President Nixon ceased direct convertibility of US dollars to gold in 1971. This ended both the gold standard and the limit on the amount of currency that could be printed. The value of the US dollar is being eroded over time, which means anybody holding cash is having that cash lose value. And it is losing much more than the average 2% per year consumer price index, which people commonly think of as inflation. Does this chart seem abnormal to anyone? Everybody's US dollar got diluted by 20% in just 1 year. The extra cash is flowing to assets and real estate, and that is where inflation is happening, true inflation is happening. Most people saw their assets increase in value last year, but if you account for the over 20% plus monetary expansion, the true gains are more modest, if any at all. Here's another way to look at it. In less than 100 weeks, the Federal Reserve printed more than $4 trillion, which is more than the whole 12 years that followed the 2008 financial crisis. Now, I'm nonpartisan. I'm not even a citizen of the United States. So for me, it is less about left or right, Democrat, Republic, but rather fundamentals of governance and monetary policy. Throughout history, whenever trust gets too low, it leads to revolution. Will that happen in the US? No, I'm not sure, and I hope not. But one of the reasons for low trust ratings is that the government does not know how to truly manage money. The US debt clock is a grave reminder that despite Washington's attempts to balance the budget, the federal debt keeps soaring. At present, the debt stands near $29 trillion, which is equivalent to $228,000 per taxpayer. The debt to GDP ratio is now over 100%, which means we owe more than we produce. And obviously, it is unsustainable to keep heading in this direction. So how much would you trust a government to solve the issue? The current monetary system is broken. We are at the first stage of hyperinflation, where a government is printing money to pay for its spending. The second stage is if the Fed does not tighten the money supply by raising interest rates, but instead keeps printing more money. So we want to keep an eye out to see if this keeps occurring. If the Fed keeps printing money and does not tighten money supply, that's a second stage. The third stage occurs if goods and services rise more than 50% in a single month. So we want to keep an eye out for this also. That being said, I certainly hope we are too smart in the United States to hyperinflate the economy. Outside of the United States, there are several countries in the world right now undergoing hyperinflation, which are marked in red. In the past, Germany, Argentina, Mexico, and Zimbabwe all went through periods of hyperinflation. All these countries are in need of a monetary system that cannot be hyperinflated away, and Bitcoin is a potential solution for them and any country subject to poor monetary policy. Even without hyperinflation, the US dollar would lose over 20% of its purchasing power within 5 years. All these countries listed in red are losing more than 10% purchasing power over a 5-year period based on current inflation rates. Bitcoin fixes this. Bitcoin is a solution for loss of purchasing power over time. So having a basic understanding of money and the problems associated with the monetary system, we can start to understand Bitcoin and explore why Bitcoin is a solution. So what is Bitcoin? Peter Diamandis, founder and chairman of the X Prize Foundation, co-founder and executive chairman of Singularity University, says, at its core, Bitcoin is a smart currency designed by very forward-thinking engineers. It eliminates the need for banks, gets rid of credit card fees, gets rid of currency exchange fees, money transfer fees, and reduces needs for lawyers in transitions, which are all good things. I'd like to offer another perspective to Peter's definition. Bitcoin is time. When we exchange dollars, money with each other, we are exchanging representations of hours of our lives that we exchanged for those dollars. If the value of those dollars are inflated away without earnings rising commensurately, which is currently happening, it is a surreptitious tax on the very substance that makes up our lives, which is time. Now, if you dig into the Bitcoin white paper, 3 out of 8 of the references in the white paper are for timestamping. Bitcoin is fundamentally a method of distributed digital timestamping. If you think about all the inventions of the modern era, the modern clock is one of the most powerful tools and a key factor of the industrial age. Bitcoin's technology evolves this and would provide a method of interplanetary timekeeping if we ever get to that stage. Reading the article titled "Bitcoin is Time" that is linked here, It is one of the most beautiful philosophical treatises on Bitcoin that I've ever read. So what is the value of decentralized digital timekeeping? It allows us to solve one of the holy grails of computer science, which is the double spend problem. Prior to blockchain, digital items could be copied, which is why we've never had digital internet money until now. The copying of digital items has led to all kinds of copyright issues with music, movies, images, data, and so on. Bitcoin solves the double spend problem that has eluded computer scientists for decades, allowing us to mathematically prove there is one and only one owner of a digital item, which allows the creation of internet money. Beyond this, the ability to create unique digital items opens up a whole new realm of possibility, which NFTs and other blockchain technologies are exploring. All valuable things are being digitized. With books, libraries have become Google. With music, CDs have become Spotify. With movies, DVDs have become Netflix. With maps, old school physically printed maps have become Waze. And so it follows that money will also be digitized. We just didn't have the ability to do so until now. If somebody says Bitcoin has no intrinsic value, they don't understand this fundamental breakthrough of solving the double spend problem. So what else is Bitcoin? Some other key facts about Bitcoin. Bitcoin was created by a person or group named Satoshi Nakamoto by posting a white paper on the cryptographic forum. Nobody knows who Satoshi Nakamoto is, and nobody has heard from him or them or her since 2011. Some people claim to be him, but nobody has verified it by moving one of the original Bitcoin from the very first Bitcoin mined in the Genesis block. The current market cap of Bitcoin is just under $1 trillion and has reached $1 trillion at its peak. Other cryptocurrencies try to improve on Bitcoin's technology or offer alternative applications of the double spend solution beyond money. So far, no other crypto has exceeded the market cap of Bitcoin in the past 12 years, but Ethereum has come close to flipping Bitcoin. One of the most unique aspects of Bitcoin that gives its good money value of scarcity is the fixed supply of 21 million Bitcoin. The 21 millionth Bitcoin will be mined in about 120 years, with the supply of Bitcoin halving approximately every 4 years, which creates an asymptotic log function of supply. Currently, there are just under 19 million Bitcoin that have been mined, and several million are known to be lost. According to a recent study by Credit Suisse, there are over 56 million millionaires in the world. So if every millionaire wanted just one Bitcoin to diversify their portfolio, there wouldn't be enough Bitcoin to go around. The world has an unlimited supply of fiat currency to buy a limited supply of 21 million Bitcoin. And this is something which helps drive its value. So how does Bitcoin work? One funny analogy for Bitcoin I came across was, imagine if keeping your car idling 24/7 produced solved Sudokus that you could trade for drugs in the dark web. Of course, Bitcoin is much, much more than that. I won't go into the cryptographic process of SHA-256 hashing, since that gets more technical than most people need to know, but happy to discuss that outside of this presentation. At a high level, the Bitcoin network is made up of miners and nodes, two groups. Anybody, including you, with an internet connection can run software to be a miner or a node. Miners solve math problems, kind of like solving Sudokus in the example I gave, to earn Bitcoin and validate transactions. And nodes, which are the real powerhouse and backbone of the Bitcoin network maintain the history of the entire Bitcoin ledger and have voting rights for the Bitcoin software. So they basically govern the entire network. To hack the Bitcoin network, somebody would need to take over 51% of the network computing power, which there are inherent bottlenecks to doing so via hardware and energy supply, which I'll also discuss further later in this presentation. As a reference, the computing power in Bitcoin is more than 100 times that of Google. So you would need multiple times of all of Google's computing power pointing directly at Bitcoin to try and hack the network. Game theory is also fascinating and plays a big role in Bitcoin. Game theory incentivizes everybody to be good actors because everybody involved wants to protect the network so the value of Bitcoin goes up. It would not make economic sense to spend billions in energy cost to steal Bitcoin, because then that would simply devalue what they just stole. Bitcoin is anti-fragile, meaning every time it survives an attack, it becomes stronger. And it is also subject to the Lindy effect, which means for every year it survives, it is more likely to keep surviving. With no CEO and no central organization, Bitcoin is impossible to sue or stop. The Bitcoin network is global, 24/7, and dynamically reorganizes on a minute-by-minute basis with a new block added to the blockchain every 10 minutes, no matter how many or how few miners there are. Currently, it costs miners just under $10,000 to generate 1 Bitcoin. So if the price of Bitcoin falls below that, then it becomes unprofitable for miners to mine Bitcoin. The size of the Bitcoin blockchain is about 360 gigabytes. So if you have the hard drive space and want to participate in the network, you can. So you've probably seen a lot of headlines like this that constantly appear on the news networks. So there is a term called FUD, which stands for fear, uncertainty, and doubt. And you're constantly seeing headlines that saying, Bitcoin is a scam, it's headed to zero, it's rat poison, etc. Bitcoin has been recorded dying over 400 times now in its history. And there's a website called Bitcoin Obituaries that tracks Bitcoin's deaths, multiple deaths over the years. You may have heard the narrative, oh, but no one uses Bitcoin. Now, in 2010, people are like, Bitcoin, WTF, what's that? In 2012, people would say, oh, only fringe nerds use Bitcoin. Maybe in 2013, people would say only drug dealers, money launderers use Bitcoin. In 2017, only speculators use Bitcoin. In 2019, oh, less than 1% of the population uses Bitcoin. In 2020, only small companies use Bitcoin. In 2021, only small countries like El Salvador, which is where I'm speaking from today, use Bitcoin. So you can see the narrative is changing. In its formative years, Bitcoin was dismissed by institutions as a shadowy, worthless digital asset favored by criminals. Gradually, sentiment has shifted and Bitcoin now bears the hallmark of institutional acceptance. When BlackRock adds crypto to its balance sheet, financial advisors and high net worth individuals naturally pay attention. BlackRock is the world's largest asset manager and is one of 16 mutual funds to gain exposure to crypto via a fund worth over $40 billion. A recent study conducted by Fidelity found that 7 out of 10 institutional investors expect to buy or invest in crypto assets in the near future. A separate survey by Nickel Digital Asset Management came to a similar conclusion. with over 80% of respondents expecting to increase their crypto allocation in the next 2 years. This is a very unique time in history to front run the institutions. Again, this is an example of how narrative is changing. Jamie Dimon, who's the CEO of Chase, JP Morgan, used to say, Bitcoin's a fraud, it will be stopped. And now, of course, JP Morgan is actively offering Bitcoin. Other news headlines that show the changing narrative and trends. US mortgage lenders are accepting payment in Bitcoin. Ray Dalio, who runs one of the world's largest hedge funds, his CFO left to work on Bitcoin full time. And we have global adoption across all the countries listed here. Just a couple of years ago, there were 0 public companies that held Bitcoin on their balance sheet. Now we have over 60 companies, 60 public companies reporting Bitcoin holdings. Michael Saylor, CEO of MicroStrategy, was the very first publicly listed company to spend millions in legal fees to put Bitcoin on his corporate balance sheet. He has since open sourced the legal documents for that, so other public companies can follow in his footsteps. And that's only public companies. We also have private companies, family offices, ETFs, and of course, governments holding Bitcoin. Here's a small chart showing treasury holdings, which has increased since September. We also have US senators, both Democrat and Republican, lobbying in favor of Bitcoin. Cynthia Lummis is a Republican senator from Wyoming and is working to get legislation passed that would establish a digital asset working group with federal regulators, including reps from the SEC and Commodity Futures Trading Commission. The adoption curve for crypto is very closely following the internet. The timing is similar to 1997 of AOL and going on the World Wide Web. Back with dial-up modems, when most people didn't trust it, didn't understand it, it was a clunky user interface, which is much like crypto today. Deutsche Bank forecasts continued adoption as per network effects. Every mainstream technology has an adoption curve. Bitcoin currently has less than 10% market penetration. Due to the connectivity of the internet, growth is accelerating. So Microsoft took 44 years, Google took 21 years, and Bitcoin took 12 years to reach a $1 trillion market cap. So use cases for Bitcoin. What is Bitcoin's ultimate killer application? If you're to leave with anything today, I'd like you to leave remembering that Bitcoin is the killer app for asset protection and asset transference, both due to its decentralized nature. So Bitcoin is unseizable, meaning nobody can take it from you against your will. Bank accounts can be frozen, real estate can be foreclosed or even seized by eminent domain. Equities can be liquidated, and gold can be physically taken. Access to your Bitcoin comes down to a passphrase which can be stored on an encrypted USB stick or even in your head. So there's intrinsic value in allocating part of your portfolio to an asset that absolutely cannot be seized against your will, even just as a shit hits the fan insurance. Bitcoin is the apex form of property rights that requires no government, no legal court, and no third party to enforce those property rights. If you secure your passphrase responsibly, Bitcoin is an unseizable asset. Bitcoin is also censorship resistant. It allows you to transfer value to anyone, anywhere in the world at any time. There currently are limits to who, where, and when you can wire money. There are limits to transferring gold bars. There are even limits on transferring your assets at death. Bitcoin allows anyone to transfer value to anyone else without any government or any third party being able to stop it or censor it. So these are the two primary killer applications of Bitcoin. Other details. Bitcoin is transparent and decentralized. Bitcoin's transparency and decentralization guards against corruption and single points of failure. Bitcoin's rules do not depend on who is elected to government, and so safeguards any vacillating political environment anywhere in the world. Bitcoin's transparency ensures there's an even playing ground across all traders and owners of the asset. You can know the exact distribution of wealth in Bitcoin at any time, and there's no Cantillon effect due to no central money printing. Bitcoin is impervious to current hacking technology. Bitcoin is the most secure computer network on planet Earth. There is an approximate $1 trillion bounty of Bitcoin if somebody were able to steal them. Hackers are trying every day, and governments have tried to stop it without success. Bitcoin can be leveraged as a store of value and offers beneficial tax treatment. Instead of selling Bitcoin and incurring capital gains tax, you can borrow against it as an asset, similar to real estate. In the United States, you can also sell Bitcoin for a loss and book the loss to reduce or eliminate capital gains tax on winning investments. Then immediately buy back the crypto you sold to capture future gains. Of course, you'll need to check with your local tax jurisdiction on your local laws. Ultimately, Bitcoin is the killer app for asset protection and asset transference. Bitcoin is also the best performing asset over the last 10 years, except for 2014 and 2018, which were correction years as part of a 4-year cycle which Bitcoin operates on. Currently, we are partway through the 4th cycle of Bitcoin. The Sharpe ratio is a method of calculating risk-adjusted return. Bitcoin outperforms all other assets despite its volatility over a 4-year period. So if you bought Bitcoin at any time in the past 12 years and held for 4 years or more, you would have over 100% return on your investment, even if you bought at the very peak of any cycle. For example, if you bought at the peak of around $20,000 in 2017, you would still be up over 100% today. People often compare Bitcoin to a bubble, kind of like the tulips, the South Sea Company, etc., or even a Ponzi scheme like Madoff. After bubbles pop, they typically don't reflate. Nobody reinvests in tulips after it pops. Yes, Bitcoin does have volatility. However, every drawdown is higher than the previous low, and the floor price keeps increasing. This is because the short-term speculators are driven out, and an increasing number of people come to understand the fundamentals, the technology, and hold the asset despite significant drawdowns. As you can see from this price graph, there is a clear, definite trend upward despite interim volatility driven by speculation. It can look like a bubble if you zoom in on any one section and look at weeks to months, but it is important to zoom out and look at full years to see the larger trend. So I've shared a lot of previous and past data, and we see clear trends from the past, but past performance does not predict future results. Can we model the future value of Bitcoin? And to quote George Box, all models are wrong, but some are useful. So I'm going to share a few models that can be used across different asset classes and applied to Bitcoin. If you find one model useful or interesting, you could explore it further. Let's start with Metcalfe's law. Network effects account for about 70% of the value of digital companies. Network effects were popularized by Robert Metcalfe, one of the co-inventors of the Ethernet. Metcalfe explained that while the cost of the network was directly proportional to the number of Ethernet cards, the value of the network was proportional to the square of the number of users. In other words, the value was due to the connectivity between the users, enabling them to work together and achieve more than they could alone. If somebody creates a superior phone, but nobody uses it, it doesn't have value. If somebody creates a superior gaming system, but all your friends play Xbox, Xbox will have great value. Facebook, Uber, and Airbnb have value because of the network, not because of the software, which are relatively simple in comparison. With any software that relies on networks, it is not the superior technology that wins out. It is the technology with the greatest network effect. Beware crypto that claims to have superior technology. Examine whether they have network effect and if the crypto's value reflects Metcalfe's law. Metcalfe's law is a mathematical and scientific fact. You can calculate it and apply it to any network, not just Bitcoin. The Bitcoin mempool is where all the valid transactions wait to be confirmed by the Bitcoin network and is an indicator of active nodes transmitting on the Bitcoin network. We can see that price action closely matches Metcalfe's law applied to Bitcoin's mempool. Another model to consider is a logarithmic regression analysis. Bitcoin moves in log, not linear format, and moves in 4-year cycles due to the halving. People often have a narrow focus on current day or week price action where there are significant drops and don't zoom out to see a longer-term view. Approximately every 4 years, there are half as many new Bitcoins added to the Bitcoin network. So Bitcoin becomes considerably more scarce, which drives the value of each new Bitcoin higher. When miners receive half as many Bitcoins for solving their math problems, they have to sell each one for more in order to cover their real-world overhead costs. There have been 3 Bitcoin halving cycles so far, and we are partway through our 4th cycle. It seems that each cycle is lengthening and flattening, which means it takes longer to peak and the volatility is also dampening. We are actually relatively ahead of schedule for our current cycle, as you can see from the purple line on this graph. Another model to consider is stock to flow, which models based on supply and demand. Bitcoin is unique in that the supply is perfectly predictable and transparent, which no other asset class has. Gold mining is variable, stock issuance is variable, even currency issuance is variable. With the perfectly predictable supply of Bitcoin, the only side of the equation solved for is demand. which we have a clear idea of by examining adoption and network effects. So here's a chart using stock to flow analysis to map the price of Bitcoin over time. A third model to consider is energy input into the Bitcoin network. In 1921, Henry Ford predicted there would be a currency based on energy. Ford's argument for energy currency was that unlike gold, it could not be controlled. Instead, every country could issue currency based on the natural wealth of its energy resources. The very first Bitcoin was based off the energy it took to create that Bitcoin. And without energy consumed, used to create Bitcoin and maintain the Bitcoin network, there would be no Bitcoin network. So here's a comparison of the stock to flow versus the energy value of Bitcoin versus the actual price. All three models have decent correlation. It is useful to use several different models to triangulate truth, and I've provided links to further in-depth studies of all of these models. Speaking of energy usage, you may have heard FUD, fear, uncertainty, and doubt around Bitcoin, boiling the Earth's oceans and whatnot. Bitcoin uses this tiny green sliver indicated here, which is about 189 terawatt hours, which is 0.1% of the world's total energy production, and actually uses 0.4% of wasted energy. Miners are incentivized to utilize the cheapest form of energy to improve their profits, and wasted energy is the cheapest form of energy because no one's using it. For example, if a solar farm is producing 2 megawatts of power, but only 1 megawatt is being used, 1 megawatt is wasted, and the costs for the solar farm have already been incurred. Bitcoin miners can use this excess energy to mine Bitcoin and maximize their profit. Wasted energy also comes in the flaring of gas, hydro, wind, and so on. Bitcoin miners are also able to profit from unmonetized energy. An example of previously unmonetized energy are waterfalls for hydro, volcanoes for geothermal, or deserts for solar. It typically doesn't make economic sense to build the infrastructure to pipe the energy from remote locations to cities where the energy is actually used. However, Bitcoin miners can monetize this by powering Bitcoin mining rigs at the remote location, earning Bitcoin, then transmitting that Bitcoin to anybody anywhere in the world over the internet. So this is currently happening in El Salvador and provides them a new source of GDP. This is an example of the Bitcoin miner, which is developed by a company powered by wasted natural gas that would otherwise have been vented to atmosphere. So Bitcoin miners are able to monetize and scrub wasted energy all over the world, reducing carbon emissions and also creating value. Bitcoin miners typically use more renewable energy as a percentage of their energy mix compared to most countries, including the US, which generates 30% of our energy from renewables. So other examples for energy usage. We're running a little short on time, so I'm just going to keep going on as far as energy usage and discuss how it ties into proof of work. So Bitcoin uses energy because of its proof of work protocol, which requires energy to solve and math problems that secure the Bitcoin network. As an alternative, there are other cryptocurrencies that utilize a method called proof of stake to secure the network. So many environmentalists that don't understand the full picture of Bitcoin's energy usage prefer proof of stake blockchains because it is not energy intensive. To validate transactions on a proof of stake network, a user simply deposits and stakes their tokens on the network. So they then mine, or rather mint, new coins proportional to how many of their own tokens they have and how long they've staked them. And so this is like a dividend. The more you stake, the more you receive. If a user acts maliciously on the network, they lose their stake as a result of their actions. So that is what incentivizes good actors. There are some concerns with this proof of stake method. For example, the network is subject to dominance by the most significant token holders and promotes a rich get richer model. So this provides power to early adopters and people with the most money. Ethereum and many other blockchains are pre-mined by a central organization, which means a few people have the most tokens, then they sell it or distribute it to others. With proof of stake, these people with the most tokens acquire the most tokens. With Bitcoin's proof of work, anybody can spend fiat to be a miner and generate Bitcoin. They then would sell some of their mined Bitcoin, pay for the real world energy and hardware costs, thereby distributing the newly mined Bitcoin. Fair and even distribution is a key challenge that new altcoins have to solve if they don't use the proof of work method. To win at proof of work, a miner has to improve the hardware and find the cheapest energy source. This forces innovation. To win at proof of stake, you just need the most money. No innovation is required. Proof of stake is also not as time-tested and proven to be anti-fragile as proof of work. Proof of work has been protecting Bitcoin's $1 trillion market cap, but no proof of stake network has that much value in it and has had it protected for the past decade. Ethereum is currently in process of switching from proof of work to proof of stake, and the world is waiting to see how this will play out. There are many other blockchain security consensus mechanisms, but these are the two major ones, and there are many derivatives of proof of stake. Let's discuss some of the biggest risks to Bitcoin. One of the biggest risks to Bitcoin is monetary policy. People who understand the cracks in our monetary system are acquiring Bitcoin as a hedge. If governments develop sound monetary policy, the pressing need for Bitcoin as a hedge against inflation would reduce. Another risk, government bans. The government could ban the possession of Bitcoin the same way that the US banned the possession of gold. However, this would be difficult to enforce. Even China, as authoritarian as they are, realized they couldn't do this. So they just banned all the fiat on-ramps, which are much easier to track and choke. It would slow adoption of Bitcoin, but not stop the Bitcoin network or break the technology itself. The bigger the market cap gets, the harder it is to ban because the donor class will own it, politicians will own it, and we now have public corporations that own it. Banning Bitcoin would destroy hundreds of billions of dollars of wealth for a country's citizens. Next biggest risk to Bitcoin, bugs in quantum computing. Since Bitcoin is code, there is a non-zero risk that it could have bugs. Bitcoin has a strong culture of security among its developers, and code changes happen very slowly and consciously, but something could happen. The promise of quantum computing could allow somebody with quantum supremacy to steal Bitcoin from any Bitcoin wallet. However, this requires extremely sophisticated hardware, and a home hacker wouldn't have the ability to do this. Also, somebody with this power has the power to crack any password in the world. So it's like a nuclear weapon. Once it is known and adversary has it, defenses can be created by altering the code. Also, if a government develops quantum supremacy, they are more likely to use it on an opposing country rather than the Bitcoin network, and there are much larger ramifications for quantum computing than just hacking the Bitcoin network. So this is generally considered a very low and long tail risk, similar to developing cold fusion as a risk to energy companies. Another risk, exchange hacks. There is an adage of not your keys, not your coin. So anytime you hold your crypto on an exchange, you are trusting the exchange to protect your assets, similar to trusting a bank to protecting your bank from bank robbers. This is known as custodial risk, and each exchange has different methods to manage this risk. Of course, you can avoid this risk entirely by taking self-custody of your Bitcoin on a USB wallet or protected passphrase. Next risk, 51% attack. Bitcoin could be attacked if someone acquired 51% of all the network's computing power to act maliciously. Game theory incentivizes all current participants to secure the network because the act of Bitcoin, hacking Bitcoin to steal it, would disintegrate the price of Bitcoin. So it's pointless to spend billions of dollars in money and energy to steal a worthless asset. However, say a country wanted to waste money and direct all their resources to just destroy the Bitcoin network. They would have to acquire 51% of the mining hardware, which takes time due to production and supply constraints, during which time the network can observe this concentration happening and react accordingly by preventing hardware sales to the bad actor or redistributing the hardware. Another risk, altcoin inflation. So Satoshi created digital scarcity, but the irony is that because Bitcoin's code is open source, it could be copied. And so we now have multiple different copies of Bitcoin, all doing slightly different things. So the argument is that Bitcoin isn't truly scarce because of all these other blockchains. While it is true, the code can be copied, the network effects cannot. So we have other cryptos like Bitcoin Cash, Bitcoin SV, Litecoin, Dogecoin, etc., that mimic Bitcoin's functionality, but they don't have the same network effects as Bitcoin. There are only two blockchains that have serious network effects, and that is Bitcoin and Ethereum. And I would say they serve two very different markets. So we're running out of time now. We need to close out. I'll just quickly move to the last slide. Bitcoin's pretty much performed all the altcoins over the past several years. We have the Sharpe ratio for Bitcoin being the best out of all the coins. Don't get caught up in Dogecoin hype. Understand the fundamentals. Here's just a couple of funny cartoons about Bitcoin. You know, Bitcoin does not have to be speculative gambling if you examine the fundamentals. So I'll wrap up here, and hopefully you feel armed with enough knowledge to make an educated decision, or at least learn more so that you don't feel like you're spinning a roulette wheel. Here's some additional resources vetted and filtered to help you distinguish signal from noise. I will hand it back over to you, Crypto Ed.
All right, thank you, Harold. Very great information. Really appreciate what you share. I know that a lot of people in the space, they don't have a strong understanding on the fundamentals of Bitcoin or even just crypto in general. And this is what differentiates like smart investors from like the typical moon boys. And just providing this informative presentation. So yeah, so thank you, Harold, and thank you everyone for joining us.